Welcome to the deep dive. Today, we're plunging into, well, one of the biggest debates out there right now, Tesla. As we sit here in mid-2025, is it basically an AI and robotics firm just, temporarily stuck making cars?
Or is that sky-high valuation really just pinned on a tech dream that hasn't actually materialized yet?
Exactly. That's the core question. And getting that right is key to understanding both the massive opportunity here, but also the very real risk. By the end of this, you'll see just how wide that gap is between today's reality and that future vision.
Right. Our job today is really to cut through the noise surrounding Tesla. That's ticker TSLA. We're using data right up to July 3rd, 2025. The stock closed at $313.73 then. We're going to pull out the key insights from recent analysis.
Help you understand that disconnect.
Precisely.
So to really tackle this, we've split our deep dive into two main parts. We'll start by building the core foundation in part one. That means digging into chapter one, business analysis.
Yeah, we'll move to chapter 2, management evaluation.
And wrap up part one with chapter 3, financial analysis. Ready to jump in?
Let's do it.
Okay, so chapter 1, business analysis beyond the car. Looking at Tesla's core business, I mean, right away, it's obvious this isn't like Ford or GM, is it? Their whole setup, vertically integrated, selling direct.
Oh, it's fundamentally different. That vertical integration gives them, well, incredible control over everything: design, manufacturing, sales, and crucially, data collection.
Right, the data.
Yeah, and that direct customer link feeds into their two main reporting segments. First, you've got automotive. That's the engine right now. Pulled in almost $77 billion in 2024.
So like 80% of total revenue?
Just about, yeah.
Yeah.
That includes the actual cars and those regulatory credits they sell. Then there's the energy generation and storage segment.
Yeah.
Smaller, maybe 10% of revenue. But that's where you find Powerwall and Megapack. High margin stuff.
And there's a services and other bit too. But what really hits me is the narrative shift. Everyone's talking about software, recurring revenue from full self-driving FSD and, robo-taxis down the line.
That's the story driving the stock, absolutely.
Yeah.
But it creates this disconnect with the current financials, like you said.
So when you look at the actual products today, the cars, Model S, 3, XY, Cybertruck, they were revolutionary, but some are getting a bit old design-wise, and competition is fierce now.
That's a fair assessment. The designs are aging a bit, and the competitive landscape is just, well, intense.
But the energy side, Powerwall and Megapack, you called them a significant bright spot. High margins, soaring deployment. Well, that's a good diversification, right?
It's a really significant bright spot. Huge growth there, high margins. It's a powerful part of the story. And then, of course, there's the software FSD and the big bets on AI and robotics like Optimus, the Tesla bot. That's all future-facing.
Can't forget the superchargers either. They seem to be everywhere.
A critical asset, definitely. Over 70,000 chargers globally now. It's the biggest network, and it gives them this incredible advantage. It's almost become the standard.
Okay, market position. They still have around 20% of the global EV market, estimates say. But is that position solid, or is it feeling the heat?
Oh, it's under significant pressure. We're seeing what you might call a pincer movement.
Pincer movement, okay.
Yeah, so in China, BYD isn't just competing. They've actually surpassed Tesla in sales volume, and they're innovating fast, like with faster charging. Tesla's China share dropped from almost 8% in 23 to maybe 6% in 24.
Wow.
And then from the other side, you have the legacy guys, GM, Ford, throwing their weight around. They've got scale, brand loyalty, and cars like the Mustang Mach-E, the F-150 Lightning. They're compelling alternatives.
Interesting. Tesla always had that mission-driven thing, accelerate the world's transition to sustainable energy, built a loyal following, hardly advertised. Is that still central?
That narrative is incredibly powerful, yeah. It built the brand. But the core value prop today is really a mix.
Yeah.
It's the cutting-edge tech, the over-the-air updates, the minimalist design.
The performance.
High performance, definitely. And that whole integrated ecosystem. The car talks to the Powerwall, talks to the supercharger network. It's seamless.
Looking at the broader EV industry, 2025 feels like a turning point. Adoption seems to be slowing. We saw that in Tesla's Q1, Q2 delivery numbers dropping. Why the slowdown?
It's a few things hitting at once. More competition, maybe some market saturation in certain areas, and just, tougher economic conditions, macro headwinds.
But contrast that with energy storage.
That market is absolutely booming. Tesla's energy segment deployments were up something like 113% year over year in 2024. They're expecting maybe 50% plus growth again in 2025. So that's a really valuable hedge against the ups and downs in the car market.
Okay, so the competitive landscape. BYD is the big global rival. legacy automakers pouring billions in, and then you've got the self-driving specialists like Waymo, Cruise. They're already testing robotaxis.
Right, and layered on top of all that competition is regulatory uncertainty. It's a big one. Will the U.S. keep the EV tax credits? Could emission standards get weaker? And then the huge hurdles, legal, ethical, safety for getting autonomous driving actually approved. That could really slow things down.
So with all that competition and uncertainty, what actually makes Tesla hard to copy? What are their real advantages, their moats?
Well, the supercharger network is definitely one. The user experience is just seamless. And now they're opening it up, which kind of cements it as the standard. That's a powerful network effect.
Plus the manufacturing scale, right? The gigafactories, the experience.
Absolutely. But maybe the most durable, most valuable edge they have is the data moat.
The data moat. Explain that.
They have collected billions and billions of miles of real-world driving data from their cars. That data feeds back into improving their AI, especially for FSD. It creates this virtuous cycle. Competitors just don't have that scale of real-world data. It's incredibly hard to replicate.
Plus the brand, the vertical integration, trying to get costs down with things like the 4680 battery, though raw materials are a challenge.
Exactly. So it's that unique combination, the massive data advantage, plus the in-house expertise in AI, software, batteries. It lets them design this tightly integrated system that's just very, very difficult for others to match.
Okay, that gives us a good handle on the business side. Let's shift now to the person arguably most identified with the company. That brings us to Chapter 2, Management Evaluation, the Musk Doctrine. I mean, you can't really talk about Tesla without talking about Elon Musk, can you? Visionary, relentless execution. He built it into a giant.
Absolutely. His track record is undeniable, but his leadership style is complex.
Yeah.
He's clearly transformational, sets these incredibly audacious goals. Think Model 3 production. Hell, they got through it.
Right.
But he's also described as autocratic, even engaging in nano management. And that's led to, frankly, high executive turnover. That instability is a significant risk.
And his communication style. Very direct, unfiltered, mostly on X now. It's powerful for getting his vision out there.
It is powerful, but it's also a real double-edged sword. His public persona is unpredictable, sometimes controversial. Remember those feuds with Trump earlier this month? The stock dropped over 5% multiple times, directly because of stuff he said.
Yeah, I remember that.
That introduces this unique, hard-to-quantify risk. It's classic key person risk. So much depends on him.
Okay, how about how they use their money? Capital allocation. Tesla's known for just plowing everything back into the business, right? No M&A to speak of.
That's exactly their strategy. Reinvest everything for future growth. And their priorities are clear and aggressive. They just announced a huge $8 billion investment in the U.S. for 2025.
$8 billion. Wow. Where's that going?
It's split. Part of it is scaling up the gigafactories, pumping out more Model Ys, getting ready for the new affordable models. The other big chunk is accelerating the autonomous tech FSD, the Cybercab robotaxi project.
So it's a very deliberate, massive bet on autonomy. Some analysts are throwing around huge numbers, autonomy adding $1 trillion to the valuation, a $10 trillion global robotaxi market by 2035. It's staggering.
It is. And for investors focused on returns now, it's important to note Tesla's never paid a dividend. They've never done share buybacks. All that capital is going straight back into fueling that future vision.
Which leads nicely into return on invested capital, ROIC. How well have they actually used the capital they've invested so far?
Historically, very well. Their ROIC was impressive, around 25.93% in early 2024.
Yeah.
That shows their past investments, mainly in cars and energy, were highly effective, highly profitable.
But here's the catch, right? The tension. That great ROIC came from building the car and energy business. Now, the big money, the future capital, is flowing into these unproven, high-risk areas like FSD and robotaxis.
Exactly. Investing now requires believing they can replicate that past success in a completely new, much more speculative domain. It's a significant leap of faith.
Okay, business management. Now for the numbers. Let's get into Chapter 3. Financial analysis, reading the tea leaves. This is where the story often gets very real. Q1 2025, what did the financials show? Were things looking good?
Q1 2025 definitely showed significant headwinds. Just to set the scene, as of July 3rd, the share price was $313.73. Market cap around $804.7 billion, with about 3.2 billion shares out there. But the Q1 results themselves. Revenue was down over 9% compared to last year. Net income, that fell off a cliff, down over 70%.
70%? Ouch!
Yeah. And earnings per share down 40% year over year. It paints a stark picture of decline across the board, really.
Except for one thing, you mentioned free cash flow was actually up.
That was the surprising bright spot, yes. If you look at the 5-year revenue trend, it was explosive growth, then this sudden deceleration hitting in Q1 25. And profitability, under severe pressure. That net profit margin just collapsed to about 2.1% in Q1.
2%. That sounds like a traditional car company margin.
Exactly. It was a 67% drop year over year. Suddenly, they looked a lot more like a legacy automaker on that metric.
So free cash flow, FCF. That's the cash left over after running the business and investing. Why was that strong?
They generated $1.3 billion in FCF in Q1 25. That was actually up remarkably 145% year over year. It seems to be down to operational efficiency improvements and also getting those customer deposits for future vehicles.
And overall financial stability, balance sheet. Hey,
Balance sheet looks strong, actually. Their debt-to-equity ratio is around 0.66, which is pretty healthy, conservative even. And they have a big pile of cash, $37 billion. Plenty of liquidity. And again, no dividends paid out.
right. Now, valuation. This is where, as you said, the Tesla story gets really polarized.
Absolutely. That price-to-earnings ratio, the PE, was sitting at an astronomical 173.59 around July 2nd.
173 compared to...
Well, compare it to its own history. The 12-month average was around 119, the 3-year average around 81. Then compare it to other car companies. Ford and GM are trading at maybe 6 to 8 times earnings. Toyota around 10x.
So the market is clearly not valuing Tesla as just a car company, not even close.
Not even remotely close. It's pricing in something entirely different.
So if we try to find an intrinsic value using a discounted cash flow model, projecting future cash flows and discounting them back, what kind of value range does that suggest?
Well, running an educational DCF model, even with pretty optimistic, though still plausible assumptions, you tend to land in a range of maybe $180 to $250 per share.
$180 to $250. Okay, and what are the key assumptions driving that kind of DCF number?
Typically, you'd need a fairly high initial revenue growth, maybe starting at around 22.5% in a few years, then tapering down to a more normal 3–4% long-term rate. You'd probably assume EBITDA margins compress slightly, maybe from 16% down to 15%. And critically, you'd use a high discount rate, maybe 11% to almost 14%, to account for all the volatility and the speculative nature of those future growth drivers like autonomy.
Okay, so quite a gap between that $180 to $250 intrinsic range and the $313 market price.
A very significant gap.
All right, we've built that core foundation, business management, financials. Let's pivot now to part 2, external dynamics and the big picture. We'll cover Chapter 4, market sentiment.
Then Chapter 5, ownership structure, Chapter 6, risk assessment.
And wrap it all up with Chapter 7, conclusion. So, starting with Chapter 4, market sentiment, the voice of the street. What's the feeling among analysts?
Deeply divided is probably the best way to put it. The consensus rating among, I think, 64 analysts is basically a hold.
A hold, not exactly screaming buy.
No. And the range of their 12-month price targets is incredibly wide.
Yeah.
You've got Guggenheim down at $175 on the low end.
Okay.
And then Wedbush's Dan Ives, who's famously bullish, he's up at $500. He sees potential for a $2 trillion valuation eventually.
Wow. Big range. What's the average target?
The average is around $248. Which, again, is significantly below where the stock was trading recently.
And the media narrative seems just as split.
Totally volatile. Lots of positive buzz around FSD, robotaxis, Optimus, the energy business. But then you get hit with the negative stories, the delivery misses in Q1 and Q2, the struggles in China and Europe, and that very public spat between Musk and Trump definitely hurt the stock directly.
Right. What about market indicators? Short interest? Are people betting against it?
Quite a few are. Short interest was around 77 million shares. That's about 2.75% of the float. It's a significant bearish bet. And those short sellers apparently made around $4 billion just on one price drop back on June 5th.
But technically, the stock price itself was showing some strength.
Yeah, from a technical standpoint, the stock at $313 was trading comfortably above its 50-day moving average, which was around $275. That's generally seen as a bullish sign in the near term.
Okay.
And the wider market had that golden cross thing going on, the S&P 500's 50-day average crossing above its 200-day, which can provide a bit of a positive tailwind for stocks generally.
Interesting mix of signals. Now let's move to Chapter 5, ownership structure. Who's at the table? This sounds pretty unique for Tesla.
It really is, especially for a company this size. Institutional investors, the big funds, they hold about 49%. That's actually lower than many competitors.
And who are those big holders? Mostly active managers making big bets.
Not really. A lot of it is passive index funds. Think Vanguard, BlackRock, State Street, who have to own it because it's in the index.
Okay, what about insiders, the people running the company?
Insiders own a decent chunk, about 12.9%, with Elon Musk himself holding just over 13%. But here's the big flashing warning sign, you could say.
Oh, what is it?
The selling. There's a consistent, overwhelming trend of insiders selling their shares. Over the last year, it was something like 37 sales versus only one purchase.
One purchase.
Yeah. And in the last 3 months, just 4,000 shares bought by insiders compared to over 830,000 shares sold. We're talking the CFO, Vaibhav Taneja, Director Kimball Musk, Senior VP Xiao Tongzhu. They've all been selling recently.
That sends a powerful signal, doesn't it, if the people who know the most are selling?
It suggests they might think the stock is overvalued at these levels. It's a major red flag for potential investors.
And the most unique part of the ownership.
Retail investors. Individual investors like you and me. Collectively, they own about 43% of Tesla. That's huge. It's even more than all the institutions combined.
Wow, so that explains some of the passion, maybe some of the volatility too, and that disconnect from fundamentals we keep mentioning.
Absolutely. That large retail base creates resilience in some ways, but definitely contributes to the extreme price swings.
Okay, let's systematically look at the risks. Time for Chapter 6. Risk assessment, what could go wrong? A SWOT analysis seems useful here. Expert, can you quickly outline the strengths?
Sure. Strengths. Definitely the powerful global brand, their clear technological leadership, that proprietary supercharger network we discussed, and their vertical integration combined with the data moat.
Okay. And the weaknesses, where are they vulnerable internally?
Well, they've had recurring production and quality issues. Their cars are still premium priced, limiting the market. There's that huge key person dependency on Musk. And manufacturing, especially at their scale, remains incredibly complex.
What about the opportunities ahead? Where is the potential upside?
The biggest is monetization of autonomy robotaxis, licensing FSD. Then there's the potential mass market vehicle to reach more buyers. The continued growth in the energy business is a huge opportunity. And just further global expansion.
And finally, the threats. What external factors could really hurt them?
Number one is intensifying competition from EVs and potentially autonomy players. Then there are regulatory hurdles getting FSD approved, changes in subsidies or emissions rules, and supply chain vulnerability is always a threat, especially dependence on raw materials, often from China.
Let's dig into those threats a bit more. Macroeconomic factors, inflation, interest rates.
Yeah, they bite in a couple of ways. Inflation drives up costs for essential raw materials, lithium, nickel, cobalt. Higher interest rates make it more expensive for consumers to finance a car purchase, potentially slowing demand. And it also increases Tesla's own cost of borrowing for expansion.
And the geopolitical stuff, especially U.S.-China tensions, sounds really serious. You call it a multi-front war.
It really is. Look at the tariffs. The U.S. has a 25% tariff on many imported auto parts, adding maybe $2,600 to the cost of a U.S.-made Tesla.
Okay.
Then China retaliated with a massive 125% tariff on many U.S.-made goods. That basically killed exports of the higher-end Model S and X to China. We're talking potentially a 75% demand drop, hundreds of millions in lost revenue.
Ouch. And the supply chain risk from China.
That's critical. China dominates processing for rare earth minerals, like 90%. If they were to restrict exports, it could massively disrupt Tesla's global production and potentially add over $1 billion a year to their costs. It's a huge vulnerability.
Serious headwinds. Okay, we've covered a lot of ground. Let's bring it all together in Chapter 7. Conclusion. Let's synthesize this. First, the bull case. Why should someone be optimistic about Tesla?
The bull case really boils down to three main points. One, Tesla isn't a car company, it's an AI and robotics company poised to unlock a multi-trillion-dollar robotaxi market. Two, the energy business is a hidden giant, offering huge growth and better profits, diversifying away from cars. And three, they have an unbreakable brand and data moat, giving them a near insurmountable edge thanks to all that real-world driving data.
Okay. And the bear case. The counter-arguments.
The bears point to, first, a valuation disconnected from reality. That 170-plus PE just doesn't match slowing growth and shrinking margins. Second, intensifying competition is real, and it's already eroding market share and forcing price cuts. Third, there's massive execution and regulatory risk around actually delivering and getting approval for FSD and robotaxis. Fourth, the big one, insiders are selling, not buying. And finally, those severe geopolitical headwinds, tariffs, supply chain risks are real and hurting now.
So let's revisit the valuation summary. Market price $313.73 as of early July. That astronomical PE of 173.59. It seems undeniable the current price is banking almost entirely on this future narrative succeeding.
Yes, and contrasting that with our educational DCF model, which suggested an intrinsic value more in the $180 to $250 range,
Yeah.
it just highlights the significant premium the market is assigning right now, based purely on that future potential.
So what's the final concluding outlook? What's the takeaway?
Well, from a classic value investing standpoint, looking at current fundamentals and performance, Tesla appears substantially overvalued. The price today reflects a very strong, you might even say total, belief that they will successfully develop and monetize these currently unproven technologies like full autonomy.
So an investment right now.
It's a highly speculative bet. It's a bet on flawless execution of an incredibly ambitious visionary plan, navigating immense competition, regulatory hurdles, and those significant geopolitical headwinds we talked about.
Okay, so let me leave you, our listener, with a provocative thought. What does it really mean when the insiders, people who know the company best, are consistently selling their shares while a very passionate group of individual investors keeps holding on and the market values the company based on a future that is, frankly, far from guaranteed? How do you personally weigh Tesla's undeniable past successes against the sheer amount of speculation baked into its current price? Something to think about. If you found this deep dive valuable, please do like this video and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers. We're planning to cover the entire S&P 500 over the next few months, and members get first dibs. Or if you just want a one-off deep dive on a stock you care about, drop us a super thanks.
And the important reminder, this analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.